Good morning, afternoon, evening to all of you. Welcome to today's webinar, Trading the Crosswinds, Macroeconomic Outlook, Trade Policy Uncertainty, and Agricultural Commodity Markets. My name is Monika Totova. I'm a senior economist in the Food and Agriculture Organization of the United Nations, and I also serve as a secretary of the Agriculture Market Information System, AMIS, a G20 initiative to enhance transparency on food commodity markets. This event is part of an ongoing collaboration between AMIS and IFPRI, International Food Policy Research Institute, that organizes webinars to provide insights into global market dynamics and policy responses. I am pleased to be joined today by Valeria Pinheiro, Regional Representative for Latin America and Caribbean from IFPRI as a co-moderator. Our conversation today will dive into global outlook for wheat, maize, and soybeans, where production prospects remain encouraging. But the story doesn't end there. Trade policy shifts, including the possibility of retaliatory measures, are disrupting traditional trade flows and creating new challenges for market players. Layered on the top are macroeconomic forces, growth rate, currency swings, energy price volatility, etc., that add even more complexity to the supply chains. Together, we will unpack these trends and explore what they mean for the future of agricultural markets. We are honored to have a distinguished set of speakers today. Let me extend a warm welcome to all panelists. To set the scene for the discussion, I'm also delighted to introduce John Baffas, Senior Agricultural Economist from the Development Economics Prospect Group, World Bank. John will speak about their latest commodity market outlook, offering a perspective on the macroeconomic drivers influencing agricultural trade and price dynamics. Before I leave the floor to John, I would like to remind the audience that to participate in our online questions and answer session, please submit your questions on ifpri.org, Facebook, LinkedIn, YouTube, or by using hashtag AskIFPRI on X. With this, over to you, John.
Good morning, everybody. Thank you very much, Monica, and also thanks to IFPRI and the AMI Secretariat for extending the invitation. The presentation I'm going to speak about for the next 10 minutes is going to reflect, for the most part, the findings that we published in our Commodity Markets Outlook, a biannual report by our group. The latest edition was published on October 30th. My presentation is going to cover three aspects. First, the global macroeconomic environment. Second, I'm going to talk a bit about energy markets. And at the end, I'm going to give you a broad idea of developments in agricultural markets as well as commodity price forecasts. Next slide, please. Let me begin with global growth prospects, and what we see in the chart to the left is that global growth is expected to decelerate slightly at 2.6% in 2025 and 2.5% in 2026. That is down from 2.8%, the average of the past 2 years, 23 and 24. It's also important to highlight the fact that when we look at global growth prospects, we like to distinguish it between advanced economies and emerging market and developing economies, as you can see in the two colored bars in the chart, blue and orange respectively. The reason we do that is emerging markets and developing economies affect most commodity markets because that's where most of the commodities are produced, are consumed, and are traded. Again, in terms of growth prospects in emerging markets and developing economies, growth is going to be at 4.2% expected for 2025 and decelerate to 4% in 2026. To the right is a very interesting slide which explains the evolution of the thinking among major forecasts about the global growth prospects in 2025 and also 2026. What we see there is throughout 2024 and the early part of 2025, the expectation for global growth for this year was about 2.6. However, expectations deteriorated throughout the second quarter of 2025. They came down to 2.2, but what we see that recently there has been an upgrade in the thinking about global growth. In other words, there has been better news and more enthusiasm about global growth prospects. And pretty much now the thinking is about exactly where we are in the latter part of last year and in the early part of this year. Next slide, please. Two more aspects of the global economy that matter a lot on commodity markets are the US dollar and the interest rates. The US dollar is very important, but variable because most commodities are invoiced and traded in US dollar, and therefore, when the US dollar depreciates, that has a positive impact on commodity prices. And conversely, when the US dollar appreciates, it negatively affects commodity prices. What we see in the chart to the left is that the US dollar has depreciated quite a bit throughout the first half of the year, about 7 to 8% depreciation against a basket of other currencies. But lately, that is the third quarter of 2025, the dollar has stabilized. That's important because, as I said, the depreciation of the US dollar positively affects commodity markets. However, what we have seen lately throughout the year is that we have seen a decline in commodity prices, which means that had the US dollar not depreciated, we have seen an even larger drop in commodity prices. And that's important to highlight this point. Now, to the right, we see the effective federal funds rate, which is, in a nutshell, the interest rates of the Central Bank of the United States. We see that we started back in 2022 with nearly zero interest rates, which increased to a high of 5.3. And since the beginning of the year, the US Fed has started easing what they call the interest rate cycle. There was a pause throughout the second and third quarter of the year, but it appears that interest rates came down. That is a reduction in the federal fund rates, and the expectation is that we may see more cuts for the rest of this year and early next year. Now, this variable is important because it affects commodity markets in many ways. First, the US, the effective funds rates that I'm showing here affect the US dollar, but they also respond to macroeconomic conditions, especially growth rate. And if growth rate prospects are good, the expectation there's an expectation that the interest rates are probably going to drop a bit more. And it also relates to the overall inflation. Currently, inflation is under control. It's a bit higher than the target of the central banks, but it's very close to the target, and that leaves breathing room to the central banks, including the US Fed, to further reduce interest rates. Next slide, please. What we see in this chart is the three main commodity price indices relevant for our current discussion: energy, agriculture, and fertilizers. We see the pre-2020 period where it was quite a bit of stability in all commodity prices, what I call the heightened risk period in the middle until early 2023, and the kind of relative stability period post-2023. In recent months, we have seen commodity price across the board pretty much coming down, with the most declines taking place in the most weakened prices, pretty much reflecting the energy index. But there are a couple of aspects that I would like to highlight. If we compare this year with the 10 months, the first 10 months of this year, that is 2025, with 7 years ago, 2018, what we see is that the nominal energy price index is pretty much at zero. Agricultural prices are about 30% higher, and fertilizer prices are about 70% higher than what they were 7 years ago now, or 8 years ago. It's important to highlight the fact that those are nominal prices. If we take into account the fact that we have a 30% inflation throughout this period, agricultural prices are currently about 30% lower in real terms. Unchanged in real terms. The energy prices are about 30% lower compared to 8 years ago in real terms. Fertilizer prices, however, are a bit higher, about 40% in real terms. Next slide, please. Zooming in the energy price indices, we decompose it by oil, the Brent, which is the main price indicator we follow, natural gas and coal to the right. Oil prices have declined quite a bit throughout the past 3 years. They had exceeded $115 back in the first half of 2022 for a number of geopolitical reasons. But since then, they have come down, and that mostly reflects the fact that there's too much oil in the market. We also saw relative stability in natural gas markets in the chart in the middle, just to highlight the fact that when we look at the natural gas prices, we like to separate it in three markets because they are quite distinct: North America market, European market, and the LNG, which is the East Asian and liquefied natural gas market. But regardless, what we see is that there has been a relative stability in most natural gas prices, which, although are in nominal terms much higher than what they were compared to 2018, again, if we account for inflation, most of them are lower, with the exception of the European natural gas prices, which are still higher. To the right, we see coal prices, which again, it's very interesting that they are a bit higher than what they were prior to the crisis, prior to 2020. But much lower in real terms. But it's also important to highlight the fact that coal prices, the shape of coal prices, mimic pretty much the shape of natural gas prices. That's not surprising because both coal and natural gas are used for electricity generation around the world. That one market is tight, is easily substitutable by the other market. That's why we see this bell-shaped behavior of both coal and natural gas prices throughout the past 5 to 6 years. Next slide, please. Let me dive in a bit closer, deeper into the oil market now. And what we see in the chart to the left is US oil production by the United States. And we see that oil production in the United States has almost reached 22 million barrels per day. That's important because if we compare that to the global oil production, which is a bit more than 100 million barrels per day, what the main conclusion is that the United States is the main and dominant player in the global oil market. It accounts for more than 1/5 of global production. It has been increasing throughout the past 5 years. In the middle, we see production of oil by Saudi Arabia and Russia. And it's important that United States produces more oil than Saudi Arabia and Russia combined. That's very important sort of development, recent development in the global oil market. When it comes to the Russian Federation, we see a kind of decline in oil production throughout the past 4 years, but the decline is very small. And that's interesting to put that in contrast with all the sanctions and the trade restrictions that have been placed upon the Russian economy, which, as this chart shows, it has kind of turned out to be very resilient in terms of exports and production. However, that's not the case in prices. Russian oil is traded at a much steep discount when we compare the Urals, which is the Russian price, compared to, let's say, the Brent, the global price indicator. Now, when it comes to Saudi Arabia, we see a downturn that took place in 2023 and 2024, but this downturn in production was reversed recently, and that has to do mostly with the fact that OPEC Plus had introduced cuts throughout the past 5 years, but the cuts have been reversed, and those cuts are mostly reflecting, Saudi Arabia production. That's what we see, an uptick in fact, a relative large increase in Saudi Arabia oil production. To the right, we see OPEC Plus oil spare capacity. That pretty much mirrors what we see in the Saudi Arabia oil production. When oil production by Saudi Arabia and the other countries of OPEC Plus goes up, we see spare capacity going down. Next slide, please. When we put everything together, what we see in the chart to the right is that we have pretty much a very large oil supplies, and that is reflected by the blue bars in the chart to the right. That it's what we call, another organization called, there's a oil glut in the global oil market that has affected the oil market as well as the energy prices. Now, to the left is a very interesting chart. It shows global oil growth demand, and the solid red line indicates long-term global oil oil demand, which is around 1.5 million barrels per day, implying that in the long term, global growth in oil demand grows around 1.5%. The growth in 2023 exceeded by much that rate. That pretty much reflected the fact that China grew a lot. That is the dark blue part of the bar, and that reflected the fact that China grew a lot because of the late opening post-pandemic. But what's interesting about 2024 as well as projections for 2025 and 2026, China demand is very weak, very small, probably close to zero, and that is a reflection of the fact that China uses much less oil now because most of its transportation has switched to other sources. Passengers car use electricity, and also trucks use most of the new trucks in China have natural gas engines, and that's why we see very little growth in China's demand. Next slide, please. Lastly, here are the agricultural price index, which I showed you earlier, which we have decomposed in oils and meals, grains, and other food. And we do see that all three components have trended downwards for the past 3 years. And indeed, when we see the average of this year to date this year, and we compare it to 2018, we see that while there's some positive, all three numbers are positive in nominal terms. If we adjust this for the inflation rate, which is around 30% throughout this period, we see that most agricultural prices are lower now in real terms than what they were in 2018. Next slide, please. Here is the supply of grains and edible oils, and we compare. It's important to compare the expectations for this year, that is for 2026, which is the light blue bar to the right in both charts. And when we compare it to the long prospects, growth prospects, or both grains and edible oils, what we see is that this year, when we add all grains, we expect them to be, the supply to be much higher than what has been over the long term. And by long term, we mean the 35-year average between 1990 and 2025. And in the case of edible oils, we also see that there's a huge growth this year, a little lower than long-term average, but again, very close to it, which means that there are plenty of supplies in both the grains and the edible oils global markets. Next slide, please. We have calculated an aggregate stock-to-use ratio, which is the chart to the left, which includes 12 commodities. Stock-to-use ratio, as most of you know, is a variable that is monitored frequently, very often by agricultural economists. It pretty much monitors the global supply conditions relative to demand. And we see that there has been a kind of decline in the aggregate stock-to-use ratio for the past 8 years or so, from 31 in the highs of 2017 to 25 today. However, if we compare this ratio with what unfolded back in 2007 and 2010, we see that the stock-to-use ratio now is much higher than it was back then. So supply conditions relative to demand are more comfortable now, and that's why kind of see weakening prices, that we do not have the fears today that we had back in 2007 and 2010 because of the tight markets back then. Now, in terms of putting the input prices together, when we compare agricultural prices to fertilizer prices and agricultural prices to energy prices, we have constructed these affordability ratios. You might have seen this affordability ratio for fertilizer prices. We see that while the affordability ratio has reversed, and it's a bit worse, so to speak, for fertilizer prices, when we compare agricultural price to energy, we see that the affordability ratio is back to historical standards, which is good news for production prospects. Next slide, please. This is the last slide of my presentation. Those are the forecasts that, as I said earlier, we published back in 2 weeks ago. I'm showing you the 2025 numbers, which are not really forecasts, they are actual numbers, and also the 2026 numbers. You see energy prices are expected to be weak, about 12% lower in 2025 compared to 2024, and 10% decline, further 10% decline is the expectation of next year. In agriculture, although not much change at the aggregate index, we see there's quite a variability within sub-indices, a huge increase in beverage prices because of the spikes we saw in cocoa and coffee prices, expected to decline next year, but not as much as an increase that we have experienced this year. And we expect grains to be 11% down this year and pretty much stable next year. Lastly, fertilizers are expected to increase a lot this year, more than 20%. We expect rather to see a decline in fertilizer prices next year, but still fertilizers are going to be elevated by historical standards. And with this, I would like to end my presentation and certainly entertain questions and answers later on.
Thank you, John, for the presentation and staying on time. I believe we will keep the questions for the question and answer segment. And without further ado, I will give the floor to Alexander Karavaitsev from the International Grains Council, who is joining us to provide a summary on short-term developments on wheat, maize, and soybean markets. Over to you, Alexander. Thank you.
Thank you, Monica, and hello, everybody. I'm Alexander Karavaitsev from the International Grains Council, and I'm going to present just the key highlights of the IGC short-term outlook for wheat, maize, and soybean markets. I will keep it really short just for the sake of timing, but I will be happy to expand and to discuss any of the points from my presentation during the Q&A session, as well as to answer any questions you might have. So just to note also, the IGC forecasts are updated on a monthly basis, and this presentation is based on our October grain market report, and the next update is due in just 2 days. So just to set the scene, and let's look at the prices and where we see it in terms of average FOB prices for grains and oilseeds and longer-term perspective. In 2022, we saw prices spike to a multi-decade high, which was in the wake of the outbreak of the Black Sea conflict, but prices have declined quite a bit since then, as you can see on this left-hand side long-term chart. The prices on average have declined to a 5-year low in September this year, but more recently there has been underpinning from US-China trade news, and to a lesser extent a speculation about the final size of the US maize crop, which has now largely dissipated after the update from USDA in the November WASDE report. And because of this underpinning, as you can see on the right-hand side, the annual chart for average prices, these FOB values are now little changed year on year or even fractionally higher, given the continued rally in futures, which we, for example, saw yesterday. Now just moving to individual markets, and first up the wheat, and we'll talk about the S&D first. So in terms of production, the volume is now forecasted record high, which is more than 800 million tons. This is up by 3% year on year. This is almost entirely owing to better yields. The major feature of this season is that all key exporters in the Northern Hemisphere have increased their production, especially the European Union, and there have been no major quality issues across the major exporters in the Northern Hemisphere. Now, if you look at the Southern Hemisphere, where harvesting is now ongoing, large harvests are also incoming, and the forecasts are now tilted to the upside. Also, record or near record production is estimated in India and China, two other major producers and consumers of wheat. However, on the opposite side, we might see some retreat in production in a number of relatively large importers of wheat, which is a good news for trade, of course, and in these regards, we should note particularly Near East Asia. So in terms of consumption, projected level now is a record high, but still falling short of production. In terms of food use, we anticipate the fastest growth in 4 seasons, but any further upside, it looks like it may be capped by competition from rice in Asia and parts of Africa, as well as maize, particularly in sub-Saharan Africa, because of an improved output of maize this season. Now also just mentioning stocks. Stocks are projected to rebound from a 6-year low, which we saw in the previous year. But the feature is most of the accumulation is expected in the key exporters, while supplies everywhere and inventories elsewhere will remain relatively tight. Now, looking at the trade for wheat, here you can see the data for global trade as well as for major exporters. So overall trade is projected to recover partially from the previous year's slump. Now the forecast is up by 6% year on year. On the import side, a solid rebound is expected in Asian demand, particularly from such countries as Turkey, Pakistan, Iran, and parts of Pacific Asia. Continued expansion in African demand is anticipated, but this year growth might be capped by better local maize outturns, which I mentioned previously. Conversely, EU imports might continue to contract, first of all, because of ample supplies and also reintroduced quotas for imports from Ukraine. Now, in terms of exports, the major feature here is potentially a further shift from Black Sea origins. Both Russia and Ukraine now are facing some logistical issues for various reasons. In Ukraine, it's linked to continued attacks on rail and energy infrastructure. We see continued reports just yesterday of strikes on the ports of around the ports of Odessa and Ismail on the Danube River. While in Russia, apart from recent attacks on the ports, which have not had reportedly any significant impact so far on grain shipments, however, the country this season needs to transport grains to southern terminals from more distant regions, which adds to times for delivery and also logistics costs. Against this backdrop, we look at most other non-Black Sea origins, and we expect them to boost their exports this season, led by the European Union and Australia in particular. Now, shifting to maize, and first with the maize S&D, production similar to wheat is projected at an all-time high, now approaching 1.3 billion tons, up by 5% year on year, including gains both in area and yields. The bulk of these year-on-year increases in the US. A record crop is expected there. So the latest official estimate from USDA came at the top of trade expectations. A solid rebound in production is also expected in Ukraine, but what should be noted here is that harvesting has been relatively slow because of rains. Record estimated crops are also in India and China with improved yields. Above average crops are also expected in South America, in Argentina, and in Brazil. Area is expected to increase from year to year, but projections are largely tentative at this stage because planting is just underway with no major issues. There have been some delays because of mixed weather conditions, either too dry or too wet in both countries, but so far prospects remain relatively or generally favorable. And on the flip side, we could see a relatively poor harvest in the European Union, potentially a 3-year low on reduced area, and with some notable quality issues for maize reported this year. In terms of consumption is forecast to expand for a third successive year, up by 3% year on year. This is a fresh peak. Broad-based gains are expected in feed use because of ample supplies and relatively competitive prices to feed alternatives across the Americas, Africa, in Asia. And processing also expected to reach a new peak, including expanding maize-based ethanol output in Brazil and also in India. And in terms of stocks, we might see similar trends as in the wheat market, as inventories are projected to rebound from a multi-year low with the accumulation in the major exporters. And much of that volume in the major exporters, around 80%, is expected to be in the United States. And moving on to maize trade. Overall trade is expected to rebound by 2%, still short of the 23-24 peak. On the import side, The year-on-year increase in our projections is mainly linked to a rebound in China's imports. We saw some dramatic withdrawal of China from the market in the previous year. We'll look at some rebound this season, but the volume will likely fall well short of the previous peaks. We also see some good demand from parts of Pacific Asia as well as from Egypt, which are expected to buy more this season. Mexico remains the largest importer, and the forecast is up year on year. On the one hand, because of growing meat demand, and on the other hand, because of restrictions on the movement of on live cattle into the US. The European Union is expected to import more compared to the previous year because of a relatively poor local harvest, which I mentioned, but the ultimate volume will hinge on demand for local feed wheat as a substitute, because feed wheat has been relatively competitive in terms of pricing against imports of maize, and we really need to monitor how the substitution goes between these two commodities. Conversely, for sub-Saharan Africa, we might see a decline. Actually, imports may halve from the previous year because of improved local supplies. Now, on the export side, the US is dominating the market. You can see the forecasts on the left-hand side. The country is expected to cement its leading role as an exporter. Shipments are seen at a second consecutive record this season. Growth in Brazilian exports likely to be capped by strong demand from local producers, first of all, of ethanol, but also feed makers, which in some cases outbid exporters for local supplies. Just in terms of Argentina, we'll look at a slight decline from the previous year because of generally tighter supplies and also stiff competition. For Ukraine, just based on our balance sheet and larger crop, there is a bigger surplus in that country, but the volume largely hinges on the pace of harvesting and also internal logistics. Now, shifting to the soybean market, the same as for other markets, we'll start with the soybean S&D. Production is seen only fractionally below the prior year's peak. So the US harvest may be down slightly year on year, mainly because of reduced sown area, but South American output, aggregate output, is expected to increase further. There may be a retreat in Argentina because of smaller area, but a new record is projected in Brazil. That country may have the 19th consecutive year of acreage expansion, which is impressive. Mixed production prospects are envisaged elsewhere. There may be a slight increase in the Commonwealth of Independent States, mainly because of an expansion in Russia. But on the other hand, we might see a contraction in Asia, chiefly in India. For consumption, we'll look at record volume, up by 3% year on year. But as you can see on the left-hand side, the growth is expected to moderate compared to the previous years. A solid expansion is expected in the three major exporters across the Americas, as soybeans remain the most important feedstock for biodiesel, as well as renewable diesel production, and the uptake in the US and Brazil are seen at all-time highs. The use in China is also expected to increase. The fourth consecutive record is projected this season. And also for stocks, global and major exporter stocks might retreat slightly, but will remain above the previous 5-year average level. And also a notable trend in inventories across the major exporters is that inventories in Brazil might exceed those in the US for the first time in 9 years. Now, the last slide on soybean trade. Overall trade is expected to reach a new peak, now pegged 2% higher year on year. And the expanding Southern Hemisphere shipments has been a notable feature in recent years. On the left-hand side, you can see a breakdown for some selected exporters in the Northern and the Southern Hemisphere. On the import side, the bulk of the year-on-year increase comes from the potentially record deliveries to China. In October, the number was projected at 113 million tons. Imports by Africa although relatively smaller, of course, compared to China, but they're also seen at a new high, largely because of increased processing in Egypt and Algeria. The European Union is expected to remain a relatively large importer, more than 14 million tons in terms of imports, but volumes there might be capped this season by relatively good rapeseed harvest. And on the export side, Brazil's exports are expected to reach a new high, including larger volumes to China. Now we see with the US rally, new crop prices in Brazil are priced competitively against the US. US exports are now seen slightly lower than last year, but again, much will hinge on continued or no continued purchases by China. Just recently, we've seen some renewed purchases, and really the final volume will be shaped by further developments. But I should also note that the recent rally in US prices for soybeans might also lead to some shifts in demand to South America from some earlier buyers, which were buying from the US before this sharp rally in prices. And also now, just to mention for Argentina, after spiking in the year before, exports by that country are expected to retreat, first of all, because of smaller crop and also expanding crush domestically. I will stop there and look forward to the discussion. Thanks very much.
Thank you, Alexander. Thank you for that. So I walk away with a relatively positive outlook on the markets, particularly if you are an importer. If you are an exporter, the picture is slightly different since there is an abundance of supplies. So we have set up a panel of private sector representative from many of these exporting countries, which I have now the pleasure to introduce to you. The first one is Dmitro Funda, Commercial Director from Tirayaki Agro in Turkey, followed by Scott Gettle, Chief Economist from American Soybean Association. Ole Hoel, Chair from Grain Trade Australia. A special shout out and appreciation for Ole who is joining us at about 2 a.m. in Australia. And last but not least, Rafael Blanc-Vera from Agri Brazil. I'm also very pleased to welcome Valeria Pinheiro, Regional Representative for Latin America and the Caribbean from IFPRI, who will help me to co-moderate. Before we start the round of questions, I would like to remind the audience that to participate in our online Q&A section, please submit your questions on ifpri.org, Facebook, LinkedIn, YouTube, or using hashtag AskIFPRI on X. Over to you, Valeria.
Thank you very much, Monica, and thank you all our panelists. It's really a pleasure to have you all here. And I think we're going to start these questions just with one that it will apply to all of you to get that perspective from the regions. So the question will be, how will you describe the current level of trade policy uncertainty affecting exports of agricultural commodities in your regional of expertise? So I would like to start in alphabetical order. So if you don't mind, Dimitri, to get your answer first. Thank you very much.
Hello, everyone. Thank you, Valeria. Thank you, Monica, for the invitation. It's an honor to be here to share the floor, online floor, with distinguished co-panelists and presenters. So by narrowing down to Black Sea Basin or like CIS area, there are not much effects of the international policies versus what we see in Americas. However, there are a few local issues to watch and to be careful about, like already mentioned, reintroduced quotas for some Ukrainian products to 5 European countries. Also, the wild card in Russia, the quota that would be introduced on the February 15th next year and would guide the second half of the marketing year, as long as export of main commodities is concerned, namely wheat, barley, corn out of there. The TMO policy in Turkey that we remember last year limited import of the wheat to 3.2 3.3 million metric tons versus the average 9 to 10 million per year. So this year so far it is forecasted as the 10% of imports, but it's very important thing to take into account. The bigger demand coming from Turkey can be a good supportive factor to both Ukraine and Russia cash prices, judging on the last few seasons. Also, some key importers out of the North Africa area, like Egypt, have been adopting new origins to the governmental import program. The Future Egypt reportedly purchased a substantial amount of French wheat this season to diversify their portfolio among the usual Black Sea origins they import, and many other participants in the area readjusted their strategies to a more short-sighted or spot in order to play safer on the cash side, looking at the turbulent environment introduced by a greater challenge coming from the United States, as long as sanctions and trade war with China is concerned. So far, so good this season. However, as mentioned, we are all prepared. It's not the first turbulent season, and Turkey has been very efficient in building bridges between the East and West, and ready to accept the call. Thank you.
Thank you very much, Jurid, really for your comments, specifically that this is not the first time that it goes through. And now, Scott, thank you very much.
Yeah, thank you as well for having me here today. So I'm Scott Kroll, Chief Economist with the American Soybean Association. We represent the nearly 500,000 U.S. soybean farmers on policy issues. So it's really been no secret this year that U.S. soy exports have really been affected heavily by policy. We have a new administration, the second term of a new administration, that tends to favor tariffs as a way to start negotiations. And so, we saw escalation of a trade war this year with China. And, China buys 60% of the global soybeans. They're the largest buyer of U.S. soybeans. You could put together all the other international buyers, and they still wouldn't be as large as the Chinese market for us. So we saw retaliation and tit for tat, and we ended up with a 20% additional tariff on our soybeans into China. Now, we did finally see a summit between President Trump and Chinese President Xi on October 30th. And that was supposed to kind of walk down some of this. We're still figuring out some of the details from that summit. We do know that China has removed 10 percentage points of that 20% additional tariff. The U.S. side has talked about purchase commitment levels from China. We have not seen the Chinese side confirm those levels yet. And so we have seen some backing off of the uncertainty, but I wouldn't call it an elimination at this point. We still have that additional tariff, which makes it more expensive for U.S. soy to go into China than Brazilian soy. We don't have full reporting on our export sales yet. We had a government shutdown, and the USDA has said that they will not catch up on the export reporting until the end of this calendar year. So we don't have a very good look at what's actually being purchased by the Chinese at this point. So there's still a fair amount of uncertainty for us at this point. We have seen positive reactions from markets after the summit, but there's a little bit of a wait and see as we get more data, as we see what Chinese purchasers do at this point.
Thank you very much, Scott, for bringing up all these uncertainties that we're still needs to have some data before we can actually make what it is and the impact that it will have. And then now we will move to Australia. So all, if you can join in, thank you.
Thanks, Valeria, and thanks for being invited to speak here today. So my name is Ollie. I'm here sort of on behalf of the Grain Trade in Australia, GTA as it's called. We cover about 95% of all the participants in the grain industry in Australia, the local millers, the local traders, storage companies, exporters. So that's sort of the background I have to bring to it. In terms of the trade policies, I think there's like 4 or 5 layers to it. So if we take the first easy one, I mean, Australia typically pays 1% tariff on our top 10 destination and ag products into the destination. So the fact that the US have taken tariff back on as a sledgehammer to the markets is, of course, highly disturbing for everyone, and that has got everyone sort of a bit on tenterhooks. So that's the easy one. The more nuanced one for us is that most of what has happened with the sort of more, if you want, the more extreme trade policies of the US has actually benefited Australia. We've never exported more beef to the US. We never exported more product apart from wheat to China. So for us, a lot of I mean, hopefully not being rude, but US-driven trade policies have benefited Australia. On a more granular level for Australia, you can probably argue that we have less policy issues that we've had in a long time. And we have had our own Chinese-Australia trade war 3 years ago. We were banned from exporting most of our stuff to China for 2 or 3 years, and that's open again. So we're going gangbusters. We've keep signing local trade agreement with Indonesia, with India, with China. There's a lot of sort of free trade agreements being finalized or being implemented. So from a sort of granular perspective in Australia, we're probably seeing more stability than we had for a while, because we've been ahead of the curve in having our wars, and then we're sort of benefiting from a bit of peace at the moment in our part. So that's the short answer.
Thank you very much. This trade diversion that benefited in Australia, that is something definitely very interesting. And now we switch gears a little bit and we move to the southern cone with Brazil. So Rafael, if you don't mind, thank you very much.
Thank you, Valeria. Thank you for having me here. It's a pleasure to join the force with such panelists. Talking about the question, so speaking as a perspective of a Brazilian trader, I would say we still live in a world where fundamentals are still strong, but there is this new thing I like to call as policy beta. So Brazil remains competitive on yield and cost. We still have land to grow and logistics improving, as Alexander brilliantly pointed out in his presentation. But the number of decisions that can change the flows overnight, be it in Brasilia, Europe, Beijing, or Washington, is much larger than it was 10 years ago. So on the external side, the first big source of uncertainty is the demand concentration, for example, in soybeans in Brazil. We rely heavily as well in one client in China. They bought about 80% of this year's Brazilian exports. In corn, we also added China in recent years, and in 2024, they were the main buyers, buying about 30% of Brazilian corn exports that year. So that concentration means that any change in sanitary rules, in GMO approvals, or tariff discussions with a single country can immediately change our export program bases and freight patterns. So the second external frontier that I would like to bring out is sustainability and ESG, for example, UDR for soybeans. So it's still being translated in practical rules and enforcement, but for us at origin, that means that we are still planning export flows for 2026 and 2027 without 100% clarity on what and what documents will be good enough for Europe. So that's certainly challenging. Then we also have the geopolitical layer other than the policy, which also affects decision. So the war in Black Sea, tensions in Red Sea, sanctions in specific countries, companies, or vessels. Even when Brazil is not directly targeted, these events reshuffle these global flows, and suddenly we may ask it to replace Ukrainian corn in one market or compete with US in the grain market, for example, that we are seeing today. So on the domestic side, Brazil is relatively predictable in one sense. We don't have a history of export bans or heavy export taxes on soy or corn, but we are not free from policy noise as well. There is still a lot of discussions about tax reform, biofuel mandates, even truck freight regulations, and licensing of new terminals in Brazil that we need to export the huge programs that we are growing. So all of these affect the cost structure, the timing of investments. For example, we are in need to invest in ports, which we do not talk about the if it will be able to export, but how efficient it will be in 3, 5, or 10 years from now. And how do we respond on this in the trading floor, properly saying in Brazil? We try to bring you flexibility in the deals that we do. So having more optionality, having flexible destinations, doing more on a cost and freight basis, which you can control the logistics to your port terminal, having wider lay days, and diversifying the client portfolio, so not relying specifically on China, for example. So my summary would be that Brazil is still a cornerstone for the global food security. It will remain to be, but there is a policy sensitivity that is clearly higher. So for a trader in Brazil does not mean that we will stop trading, but the policies right now and the policy decisions are now as important as it is a rainfall, for example, in Mato Grosso. So I would like to thank once again and look forward to the discussions.
Thank you, Rafael. It was actually very, very clear and how you brought the uncertainty from also some other points that haven't been mentioned, like the sanitary rules, the UDR, and so forth, and the importance of bringing flexibility into contracts and into your whole perspective about how to embrace the future. Thank you very much. And with this, let me pass the floor again to Monica.
Thank you, Valeria. I am told to remind everybody to post the questions on ifpri.org, Facebook, LinkedIn, YouTube, or by using hashtag AskIFPRI on X. We have questions coming in, but we would like to give you an opportunity to ask whatever burning questions you might have for our experts. John and Alexandra will join us in the panel discussion shortly. So with this, I would like to go back to Dmitro and ask him a little bit more about the Black Sea shipping. So Dmitro, you said that this, of course, is not the first turbulent year the Black Sea basin is experiencing in the last few years. There have been some improvement in the Black Sea shipping, but we can safely say that the level of shipping is not what it used to be before the war started, right? So compared to previous season, I would like to hear more about the eventual disruptions in the Black Sea corridor now, and in particular, how the insurance premiums are affecting or unlikely to affect the grain flows from the Black Sea basins outside. Over to you, Dmitro.
Thank you very much, Monica. That's indeed a nice question. I don't know what we are getting ready for, because every season is another challenge, and another one seems to be even more interesting than the previous. But I would like us to stay optimistic that whatever is about to come is going to be better, because the humanity showed a good path of getting ready to everything. So speaking about Black Sea logistics, indeed, it was hampered big time starting from February 2022 and during the first year of so-called GSCC corridor. Logistic was not going through perfectly, what caused the steep price increase we saw on the graphs before, and what was successfully dealt with during summer of 2023, when Ukraine launched an alternative Ukrainian, in brackets, corridor involving Sulina anchorage near the Constanza, by having all the vessels passing by along the European coast and then waiting at the safe anchorage before the time they actually called for cargo operations. By that, the pace increased significantly, and since the August 2023 until now, we've got like 155 million metric tons of all cargo shipped through that corridor, of which 92 is grain cargoes. It's roughly 6,000 vessels of different sizes and types, what is very close to a pre-war levels, I would say. If we look further at Ukrainian logistics, because I'm focusing more on Ukraine because Russia hasn't been affected that much for the deep water ports flow. So far this year, there were 2.1 thousand vessels served out of big Odessa ports, Pivdani, Chornomorsk, Odessa, roughly 210 vessels per month. And there were no any problems reported. And all that regardless the continual air alarms, strikes, drones attacks, rockets attacks, electricity blackouts, and other railway challenges that the Black Sea generally is facing, both Ukraine and Russia. So the industry has adapted perfectly to these conditions. However, less dramatic situation would be welcomed to make sure all the cargo, all the grains that are expected to be grown and produced reach to the destination. The Black Sea is the grain basket for the Europe, and now not only for the Europe. However, not all the cargoes can be successfully delivered. It was also the case when the big war struck, that the Ukrainian port infrastructure was not simply there, and alternative roads like railway cargo deliveries across the border with European Union, truck deliveries, and Danube ports were not there physically or in terms of capability to substitute the flow. Now it's okay, and as long as insurance cost is concerned, as I said, the actual time the vessel spent at the port was limited to a few days, and it's been that efficient that we can put plus or minus $1 of extra insurance cost that is being dealt with by the main freight operators and freight users out of the area. During the first quarter of 2025, we saw lowest freight rates out of Black Sea to Middle East, North Africa, and further for the last 7-10 years. The freight from Ukraine to Marmara was around $12-13 for a handy-sized vessel, and like $14-16 to Egypt. So we can clearly say that insurance cost wasn't and remains a tiny part of the total cost portfolio. Instead, the natural supply and demand factors, they are more important for the market participants, because with more cargoes coming now, starting from like July, August, followed by October, the early crops, late crops, turned the levels 20-30% up without any airstrikes, without any extra insurance cost. So there's one small note I would like to add before I wrap it up. The vessel that was mentioned by Alexander was for Turkish ship owners. And looking at 2025, 40% of the vessel flow coming to Ukraine belongs to Turkish ship owners, 20% to Greek ship owners, and the balance to the basket of different flag countries. So environment challenges us all the time. I hope we would remain calm and wise, but I don't want to think about how freight can be affected if those 40% of cargo of the freight owners would decide to add extra for the security. But fingers crossed. Thank you very much.
Thank you, Dmitro. So, I mean, the shipments from the Black Sea, obviously, in North Africa and Near East, this is the closest destination. So those remain the crucial markets. Last year, we also experienced shipping disruptions through the Suez Canal and the Red Sea. So this brings me to Oli. You said that the Australian exporters, the farmers at the moment, they have it. Australia has it pretty good in this overall situation. So have you, let's say, are Asian buyers increasing demand for Australian wheat as well, possibly as a hedge against the instability elsewhere? Or how would you see it for the wheat growers in Australia?
Yeah, I certainly think the Asian buyers and buyers around the world, when the war started in February 22, there was a lot of running to Australia and buying of wheat, and a lot of extending the forward coverage, because we all thought, and so did the traders and the Asian consumers thought this was going to be a problem. Ever since then, though, and there's something brought up by both Alexander and Dimitri as well, but ever since then, prices have been going down, and I think we are relearning that in many respects, food will largely be kept outside the sort of wars, if you want, whether we're talking the Iraq War, whether we're talking Russia, that we've managed to keep those trade flows happening. And if anything, I mean, Russia was exporting on average 35 million tons of wheat every year before the war, and 49 on average since the war. So yes, it's not about the war, it's about the fact that they had the production. And that's probably a big thing as well for all of us, that to some extent production overrides a lot of the policies, because trade will find a way. It's just a question of how far you have to go to find that way. But to get to the end of the question around the Asian buyers today, absolutely not. We have our base load of normal Asian clients, and the last 2 years they bought steady and the same. But I think the big thing that has happened, and this is again a three-tiered one, but all Asian buyers, because of the uncertainty and because we do have enough supply, the forward coverage, the forward level of purchases they have, which might have been 3 or 4 months or even 5 months just after the Russia-Ukraine war started, today that is barely 2 months. And it's happened big, not so much because of the policy, but because it's been easy enough to pick up the phone and have wheat loaded on the boat next week or next month. So that there hasn't actually been, because the A, world is abundant, and B, the trade flows are still happening. The consumers are probably less forward cover than they've been in several years, which is, you could argue this is building up to be a big problem the day we have a crop issue, or the day that anyone says, or Russia says, sorry, there's a ban on export from tomorrow, because there isn't a lot of forward cover. And there's a whole other discussion, which we'll get to in a second, I'm sure, about how the grain trade has reacted to a lot of that uncertainty as well. But for the consumer, initially, yes. Today, absolutely not. It's quite the contrary. And Australia has had five big years as well. So we have stuff in the cupboard for stock. You can pick up the phone here and get grain within 4 weeks if you want. And that's what keeps the buyer absolutely short for it. And with all the uncertainty, the worst the buyer can do is to buy too expensively and find out his competitor bought $5 cheaper. And I think everybody's almost risk averse to the point where as long as we all keep it bare minimum, no one is losing out too much, because in this market it's margins are squeezed everywhere because we have the food affordability crisis. Is not just an Australian issue, it's not just a US issue, it's a global issue everywhere. So I think everybody's getting squeezed on the margin for food products. And again, it's easier to do bare minimum, then you can't go all wrong, because if everybody else is doing the same, you're good. So that was the long answer to a short question, but initially yes, no, today no.
So, I mean, it's good to know there is plenty in the cupboards in Australia, because if when a drought hits in Australia, it can hit really hard, right? So
Yes, we can lose half a crop. It's not
So,
like one of these good European droughts where you lose 10%.
over to you, Valeria, for the next round.
Thank you. So let's see, Rafael, looking forward, how might Brazil allocating more maize to ethanol work impact its export potential and dynamics on the domestic market?
Okay, thank you for the question, Valeria. So if we look at the last decade in Brazil, one of the most important structural changes that I would say it happened was that we created a new demand center, corn-based ethanol in Center West. So 10 or 15 years ago, when we said ethanol in Brazil, everyone just thought about, oh, sugarcane in Southeast. So today, when I travel to Mato Grosso or Goiás, I see modern corn ethanol plants with huge storage capacity competing directly with export channels for the safrinha crop. So this new industry grew very fast. It started from almost zero in a few years and became already a significant share of Brazil's total corn ethanol throughput and domestic corn ethanol consumption, corn consumption as well. For example, we estimate 27 million metric tons of corn consumption just to ethanol for the upcoming crop, 2026. So if we are saying from a farmer's center west that we changed the map, before they only have the outlet of exports, having to hope that the freight price was right in the countryside, having to pray for a good and decent enough basis, for a decent enough FX, and for a decent enough Chicago to have their price. Right now, they also have the outlet of a corn ethanol producing plant, which is based on fuel prices. So gives a lot of change to this landscape. So it increases three important effects. It supports local bases, especially on those regions, the Center West, which lifts the reais per bag compared to areas that are just dependent on the export channel, which was the case for Mato Grosso, for example. It also changes the seasonality. So farmers were producing safrinha and had to export until December because the soybean crop was coming. Right now, they can try to hold and plan their logistics for longer to supply the corn ethanol producing plants. And third, it diversifies the farmer revenue. So as I mentioned before, their economics was heavily dependent on Chicago and FX, but right now it is also on fuel prices, which, by the way, we are seeing the growth on the corn ethanol producing plants. It's quite high, the margin for the corn ethanol plants, so they are able to pay more than the export parity is currently paying. From the export point of view, the quick question is, does the ethanol reduce Brazil export potential? I would say it makes our export surplus less elastic and more policy sensitive, but not necessarily smaller in volume over the long term. We will still be able to supply the world with decent enough amounts of corn, but in tighter years, the competition between car tank and feed will all certainly bring a lot of this demand internally and export less of this surplus. Looking ahead, I see this as both a risk and opportunity. The risk is that buyers who were used to counting permanently on growing Brazilian corn surplus will need to adapt to a more nuanced reality because the farmer will now always have the option to hold and sell to these industries at maybe a carry price or even better price opportunities than it was back then. So where the marginal ton will go, that remains to be seen, and it's closely tied to the previous question you asked, Valeria, which is where the policy will be, how the biofuels will affect this. And thank you for the question.
Thank you, Rafael. And if you don't mind, can I ask you one more thing? So do you see already a change in investment in terms of these logistics? You're switching now from just concentrated in moving your corn to the ports to export, and now it just stays closer to where it is produced. So you have a whole discussion about, transportation or just in having more sites or something there. Do you already see some of that?
Yeah, especially this year has been very challenging. So one of the outputs in Brazil is Northern Arc, so which means Barcarena, Santana, Santarém, Itacoatiara port, and also Itaqui. This Northern Arc is majority supplied by Mato Grosso state. And in Mato Grosso is the highest growing regions in the corn ethanol producing plants. And this flow this year was constantly above export parities. So many of the players this year took the loss due to the take or pays that we have on the market to have to use the assets that we committed, even though we had a record crop of total 140 million metric tons of corn in Brazil. But now I see the positioning a little bit different. More players focusing on less of these flows to the north and more on these flows to the south, especially for corn, not so much for beans, because in beans we are still very competitive given the amount of production that we have in Brazil.
Thank you, Rafael. Thank you very much. And now moving to Scott. So with increased crush for biodiesel, where do you see the additional soy meal going? And if it is exported, to what markets do you envision that? Thank you.
Yeah. So, I talked earlier about some of the challenges on the policy side in the export market. Renewable diesel or HVO has been one of the bright spots for us the past few years overall. We've expanded our renewable diesel capacity by a fair amount. We've also been increasing our domestic crush plant capacity. So if all of the announced plants were built, it would be over 20 new or expanding plants for a 30% increase in capacity. So it's very substantial. And there have been some challenges on the policy front with this as well. But things are getting to a lot better place. So yeah, one of the questions that we get asked quite a bit was where is all this soybean meal going to go? And so the industry's been working on that, and not to be too offhand about this, but kind of the economics answer is markets will find a way. It'll be priced competitively to move. There is room in some of the domestic rations to absorb more soybean meal. So I do expect, and we are seeing a higher increase or an increase domestically. But we've also been investing in infrastructure to move soybean meal. So it doesn't move as easily as whole soybeans. It doesn't flow as well. So we have seen investments in port facilities to be able to handle the soybean meal, specifically in the Pacific Northwest. So I think a lot of this, could end up in Southeast Asia. I think there's some opportunities in the EU, and some in Central America as well that have been building their poultry flocks. Um, but I also think there's a little bit of a chance now with some of the tr international trade relations and the reshuffling that we're seeing. For instance, Argentina has been soybean meal, soybean oil exporter historically, and really hasn't sent many whole soybeans to China. We saw this year that they sent increased amounts of whole soybeans to China, because China had the tariff on U.S. beans. And so, I mean, there's a lot of different ways this could play out. But one could easily tell a story if the trade frictions remain there, where Argentina is sending less soybean products, fewer soybean products out, and more whole beans, and opening up more opportunities for soybean meal. Because typically on a lot of the ASEAN countries, the U.S. has had very little market access. It's been mainly an Argentinian market, and so I think there's some opportunities as well, depending on how the reshuffling works out.
Thank you very much, Scott. So with this, I would like to pass the floor to Monica. Thank you.
Thank you. Let's bring to the discussion also John and Alexander. We still have about 15 minutes to go. So, John, starting with you, if I may, how confident are you in the forecast you presented? Are you with us, John?
Sorry, can you hear me? Yeah.
Yeah, we can hear you now. So, how
Thanks.
confident are you?
I think we're quite confident in the following sense that when we put together our forecasts, we are also looking at the risk factors around the forecasts. And what I can say is that the risks now are less important, I would say, compared to the risks that we outlined in our April report or of our commodity report that we published a year ago. So I would say, relatively speaking, compared to the forecast that we have been putting the past 2 to 3 times, I would say that we are more confident now. And one of the main reasons is that it came out very clearly, I would say, from the panel discussion and the various participants here, that we're in a situation where we have well-supplied markets. Again, this goes far beyond the grains that were discussed very well during the past half an hour or so. We see that across most commodity markets, especially energy markets. We do have some exceptions, whether it's coffee or cocoa or a bit of fertilizers, but overall we have well-supplied markets. We have trade issues that, okay, they're important, but they aren't as binding as we thought they would be earlier on. Growth prospects appear to be fine. So overall, I would say I'm quite confident on our forecast that we kind of see weakening prices as we go forward.
So, but weakening prices bring with themselves also a response from the producers, right? So eventually, if the prices remain low next year, the plantings are going to be lower. Does it disturb you or not really?
Well, again, at the end of the day, when we say in commodity markets, it's good news or bad news. It depends whether you are a producer or the consumer. But that's a good point that we raised, and in fact, that's one of the reasons is because of the cyclicality you just highlighted. Is that we expect some rebounding, so in some prices next year or the year after, by the way. But you raised a good point. Most of the commodity prices, especially the crops, are highly cyclical, and we expect that rebounding to take place. We don't expect
for 25, 26, we are okay.
That's right. Yeah.
Should be. So let me bring in Alexander. Alexander, you here in the discussion. I'm pretty sure you follow closely what was happening, what we discussed with the panelists. So just in few minutes, in what you heard here today, how did it inform your outlook? On would you change anything in your presentation had you had the knowledge from the countries that you just heard? Over to you, Alexander.
Thanks, Monica. I wouldn't say I would change anything drastically following this discussion, but all the comments from all the country representatives have been really, really useful. I mean, in a way, it confirms our understanding of the market, not only in terms of what we know at this stage, but also what we don't know. And particularly on the comments from Scott regarding persistent uncertainty in terms of future exports of soybeans from the US. It really hinges on the further policy developments. This is what we will be looking at. And I should note that also Scott's comments on soy meal exports are really encouraging, and this is of particular interest to us because many were asking questions with the expanding renewable diesel capacity, whether demand will be in place to absorb all the associated production of soy meal. And we've seen prices for soy meal, average prices across the three major exporters to drop to 15-year low in July this year. There has been a rebound more recently, partially based on the rally in soybeans. But as Scott noted, there is demand, particularly from Asia, and his comments about this additional investment and infrastructure in Pacific Northwest ports is really encouraging. So that really confirms our expectations that there will be some support to soy meal prices regardless of the potential increase in output of soy meal in the United States. So for other comments for Brazil, I think Rafael really confirmed that Brazil now is at the point of no return. This is a structural change. There will be more volumes used for maize-based ethanol, which in a way will limit export capacity for maize in particular. And then we are going to do our 5-year forecasts very soon. So it will be quite a challenge to put a number on the use of maize for ethanol in Brazil in 5 years, because there is a wide range of expectations there. Most of them are optimistic, but to put the exact number, it's really difficult. Now, for Ukraine, what Dmytro said about the resilience of the port infrastructure, this is what we really has been observing. Now, we see reports that following recent strikes, yesterday's strikes on Ismail and the port of Odessa, there has been a significant rise in freight rates for barges and coasters. Coasters are the small vessels below 10,000 tons dead weight. There haven't been reports of any increases on ocean-going vessels. But again, we already see an increase in freight rates, and this is really will be the focus in the coming days. We will be looking at this. And I was mentioning the reintroduced quotas on Ukrainian exports for the European Union, which means that Ukraine now needs to use and export longer term distances and need to export to more distant countries, more distant importers, and freight rate becomes much more important here when we talk about larger shipments, ocean-going vessels. So we'll see how that might develop. What Oli said about Australia, it's looking really optimistic this year because we saw some accumulation in stocks from the previous year. Now there is a large crop incoming, and we anticipate that some pressure on prices for wheat will be coming from Australia as well as from Argentina. Argentinian prices are the most competitive on an FOB basis, but we also expect a decline in Australian prices. I heard some comments just recently at the conference in Geneva from one trader from Australia that farmers are not really selling. But at some point, they should start doing that. And yeah, as Oli mentioned, probably not for wheat, but for other commodities, demand has been really good, including from China, maybe a bit of more competition from the US in the wheat market this year, because prices are much more competitive than last year. But overall, we are quite optimistic about Australian exports this year. Yeah, so all in all, thanks very much for the insights, and yeah, really useful. Thank you.
So Australia is also doing very well on beef, I understand, when it comes to export. So before I hand the floor to Valeria for the last question and also for a wrap up, I would ask Scott and Rafael a question. It's not meant to be a provocation, but on the soybeans, the US soybeans and the Brazilian soybeans, like perfect substitutes, or is there some sort of a difference in the protein in the composition? Over to you, Scott.
Yeah, happy to answer that. And yeah, hopefully not to stir the pot too much. But there are some quality differences. U.S. soy, one of our largest advantages is our moisture content. We tend to have pretty low moisture content, especially the past couple of years. We've had very dry harvests. So whenever buyers are buying our soybeans, they're not getting a lot of water in them, so they're getting more of the actual product, which has really good yields. The other advantage with that is they store very well. U.S. beans are very good beans to put into storage because of that low moisture content. They're gonna keep for a long time. Brazilian beans, and not to overstep and talking about Brazilians, tend to have higher crude protein content, but the amino acid profiles and the digestible amino acids from the US are very good and can outperform there. But so that's kind of the advantages we see is generally when you can buy US beans to put into storage, and that's typically China will do that if they're trying to fill stocks or reserves. Oftentimes they'll buy US or sometimes Argentinian beans for that low moisture content.
Would you like to add to it?
No, as Scott pointed out, Brazilian beans has higher protein, which is good for crushing right away. So that's what normally privates prefer in the China destination market. And for reserves, normally the state-owned companies like Sinograin, when they have to recycle the reserves, which normally happens now, they buy from US mainly due to this lower moisture content.
Well, thank you. So that was less conflicting than I thought. So I will pass the floor to Valeria. Over to you, Valeria.
Thank you. And this just last question, and actually it came from the audience. So maybe if all and Dimitri of you can answer it kind of quick. And it goes more into trade finance. So the question is there evidence on how trade finance has eased today's challenges or made it more difficult for traders? So I don't know, what's your point? All first? Thank you.
Sorry, I'll try and be quick, but this comes back to the point. I mean, the traders, following the uncertainty in trade policy, following the Ukraine war, I think the traders are doing less of one of the tasks they do. Traders have got two tasks in life. They're going to move grain from A to B. That's one task. The second task is to buy grain when the farmer wants to sell, and sell to the consumer when he wants to buy, and take the risk in the middle. Due to the high cost of trade finance and the risk and the policies, the traders are doing a lot less of that middle bit of taking on the risk, which has a few impacts. A, the grower ends up having to arrange their own finance, which is another whole other path. But it also means, and I'm going to deviate a bit from the finance question, but it also means that the connection between the farmer now and the consumer are much more direct, because the farmer globally, not just the Aussie farmer, holds a lot more power, B, they hold grain for longer, because we have approached cost of production in many areas. I mean, Australia is 10% above cost of production, but in the US, when we get wheat at $5 a bushel, and corn at $4 a bushel, you're quite close to cost of production. So it does mean that whole middle part of holding grain and waiting for the buyer to come and buy it it has shrunk to, I don't know the exact number, but it's less than half of what it was 5 years ago. So it doesn't directly answer the finance question, but it does impact on the willingness and ability to trade, to sit in the middle and hold the grain.
Thank you. And Dimitri?
Thank you, Valeria. Trade finance had not been very accessible for Russia and Ukraine before the war. So now it's even more challenging for the local farmers to cope with that. But okay, on the fourth year, they managed to sit even tighter on their stocks. They try not to sell during the so-called harvest pressure times, which we haven't seen for some time already. So they have enough storage. They have a good fat underneath the skin to sustain the half a year, 8 months of waiting. And they wait for the short and burn traders who need to feel the take or pay elevation, who need to run the floor for the program. So those traders sooner or later would come to a big farmer to originate, to purchase. So situation is not improving for the moment. We need to see a resolution first, and then there would be a long process of rebuilding the infrastructure and security protocols, etc., to welcome access for trade finance providers from all over the world, because Ukraine, Russia, on their own needs would not be able to cope with the requirements. Thank you.
Thank you very much, and thank you all of you for putting some more questions. Unfortunately, we ran out of time. I think that this was a very interesting conversation, and it was something that came up is the disruptors we see right now is this changing geopolitics and so forth is really cause some transition cost. And this uncertainty is creating these transitional moments even more difficult to prevent and to really adjust and adapt. But I really like that. I always think that markets adjust. So it's just a matter of finding that transition in between and try to minimize the costs that come from that transition. But I really liked actually what Scott said today, which says markets still find its way. So it's another way of saying exactly the same thing. We will get there, but it is clearly that the fundamentals are key in how we go through, again, that transition period. So thank you all. And before I actually close this, I just wanted to thank one more time all the panelists. This has been a very interesting conversation. Thank Amy's and Monica, and thanks the IFPRI team. The IFPRI team is amazing, so we can make this happen thanks to them. And just one last message that we will have another of these webinars in 2026. So the beginning of that, Monica will get to all of you to discuss exactly when, but that is a message that I was supposed to be saying here. So with this, happy holidays for everyone, I guess, even though it looks like we still have a long ways to go till then, but we will see you back in 2026. Thank you very much.